Hey traders, welcome to the channel. I'm your trader and trainer, Mr. Paraskul over here. So in today's video, we are going to understand a very important concept as to how to make money in the first hour of opening. What we're trying to achieve over here is to have a very beautiful trade in the first hour of the market. Whenever the market opens, let's say 9 a.m., 9:15 a.m., or if you're any other time zone, what we're learning today is to take a trade in the first hour of the market. And that trade is going to change your life and change your trading, because the setup that we are going to discuss over here has the highest probability move. And the volatility that you see in the first hour of the trading, and you sometimes in the FOMO fantasize that if and by somewhat means you knew how to catch that big move. We are going to discuss today exactly step by step as to how to catch that big move of the opening market. So let's move on to the first slide over here. Let's understand why opening trades, because most amount of big money is involved in the first hour as soon as the market opens. The opening time around 9 a.m., 9:15, depending upon your time zone, you have to understand that the first hour has the highest volatility in most days. No doubt there are some days where you will see that the volatility is less, but 90% of the time you will see that the opening hour of the market is highly volatile. And there are various reasons behind the same. All the institutions are placing their bets and the most liquidity is present over there. So basically, there are two crucial times when the institutions place their large bets in the market. In the last hour of the closing, similarly, in the first hour of the opening market, you will see highest volatility. Most of the times you have come across big moves, something like this or this, and you wanted to catch these moves. So that is why we have this crucial video to understand and decode the opening hour of the market, which is highly important. All the fundamental and the economic news takes action in that hour. Since you know, guys, all the economic news and the fundamental news that releases before the day, let's say the previous day in the night, or let's say in the morning itself, then you have seen that market has actually taken a huge moves towards the upside or the downside. And that in the first very hour, all the traders and all the investors are setting up their previous trades as well. And that is why the highest liquidity is there, because let's say if there is a very unfavorable news which has been released around 8 p.m. yesterday, so what are the traders or what are the investors are trying to do over here? As soon as the market opens, they want to get exit from that investment, because that investment might lose them money. So that is why opening hours are very crucial. Not just traders, even the investors are involved to set up their positions. So that is why you will have the highest liquidity if you are a big trader and you have good capital and you always wanted to trade in the high volatility as well as the high liquidity zones. Then this is the perfect time zone for you guys. While we are trying to understand the trades in this video, we are actually focusing on the index trading. However, if you are a gold trader or if you are a CFD trader, then you will see that the same bets are placed in the opening markets, in the commodities as well as in the other derivatives. So that is why it becomes very crucial that if we are able to catch the opening trade and if you're able to monetize it, it becomes so easy to make money and the whole day is free, because you don't need to work for the whole other day. You don't need to for the full six and a half hours in the whole market. You can just take your day off. As soon as we get the first trade in the first hour around 9 a.m., mostly I have seen that even in my strategy that our trades around 11 a.m. we are out of the trade and we have made some good money as well. And then the whole day is yours. You can enjoy the whole day with your family and doing other household chores and, expanding your day and horizon to other co-curricular activities as well. You don't need to stick your eyes and blur your vision while looking at the charts for hours and hours. Just have that mentality that you are trading in the highest volatility period, and then also the liquidity is on your side, because most institutions are taking their bets in the first hour only. So that is why it becomes very crucial if you are able to catch this first opening trade in the market. Let's move on to the next slide and let's see how to take the opening trade. So before wasting any time, we are going to understand the whole setup, the step-by-step methodology that you have to follow from the previous day to the next day, and how to expect where the market will go in that next day itself. So let's say if the previous market closes and then you are sitting at the 9 a.m. in front of your desk, in front of your PC, and you're about to take the trade. As soon as the opening reaction comes up, we are going to take the trades and we are going to place the bets in the right direction, and we are going to make some money in the first hour itself. To do that, you have to go through all of these steps. These are very crucial and these are very logical as well. You don't need to mug up all these steps. These steps are very logical. And once, if you understand the logic behind these things, you're going to have a blow in your mind that how is it possible that we are able to decode such a uncertain market in the most certain steps. Okay, guys, before starting, please do hit the like icon and the subscribe icon. And if you have any queries, do not hesitate to mail me at thenovalasset@gmail.com. I'm going to soon put up my WhatsApp number as well if you want to connect. And if you have any more queries, you can mention in the comment comment section as well. So first of all, the step one to take out the opening trade in the market is you have to read the last half of the market. So basically, whatever the previous day has closed with, you have to read that market post 12:30 p.m. of the previous day or the previous price action that already been taken. Okay, and there are only three limited possibilities. What can happen? We are going to conclude that into only three things. That is, either the price will close upside. So what will happen is that the price will try to close towards the upside, or the price will try to close towards the downside, something like this, or the price will close sideways, price consolidated in the last half of the previous day. Okay, so I have some pictorial examples as well. So let's move on to the slide and you will see this is a very perfect example how the price is closing up. So this is the chart of the previous day. Whenever you're trading in the previous day, mark a vertical line over here around 12:30 when the second half of the market, and you have to judge from this level. As you can see, the price actually moved towards the upside and closed towards the upside. So this is how we can observe and we can conclude that yes, today the market has closed towards the upside. Now comes the next example. This is how the price closes towards the downside. This is the 12:30 p.m. candle of the day. And then you will see from here, the price has actually gone towards the lower highs and lower lows and has closed towards the downside. So the second half of the decorum was on the downside. And last but not the least, if you will look over here, this is how the sideways market happens. So after giving us a good momentum in the first half of the day, exactly around 12:30, you will see that the price has actually started from here and somewhat closed around nearby itself. The price is not purely goes down or purely goes towards the upside. Rather, you will see where the price was trailing around 12:30 p.m. the candle, you will see that the price closes in that same box over here. So if I'll mark a box over here, so this was the candle. And accordingly, we will see that the price was near or close near to this candle. So that means what? This is a pure sideways market, or the market closed sideways on the previous day. Okay, so these are the major three possibilities that can happen. Either the price will close towards the upside in the previous day. When the price started from here, it went towards the upside and it closed towards the upside only. In this case, what we are seeing is that the market is moving towards the upside in the second half of the market. Similarly, what can market do? The market can go sideways around second half of the market. The market was around over here, and then by creation of lower highs and lower lows, the market actually closed towards the downside only and not towards the upside. So it's very simple. What you have to do, you have to look at the candle of the 12:30 p.m. itself, and you have to look whether the price closed towards the upside or it went towards the downside, or it is closing very near to the range that is known as the sideways market. So these are the only three scenarios that can happen in the previous day itself. If the market closes, you have to read market data post 12:30 p.m. of the previous day. The price has only three ways to go. Either it will be a buy leg, it will be a down leg, or the price will have consolidation in the second half of the day and the price will go sideways. So out of all many circumstances that can happen in the market, what we are trying to do, we are trying to adjust with the data of the closing of the previous day and the opening of the next day. So this will give us some kind of caricature of the highest probability where the market really wants to go. And by the end of the video, when you will connect the dots with me, it will be really eye-opener for you, because it will give you a lot of logical thinking to your brain why you wanted to, short from that opening. Many times you will see that the price has started moving towards the downside as soon as it opens in the market, and it has given us a good momentum, and you're not able to catch the trade no matter what. Similarly, most of the times you will see that the price will shot up towards the upside and then will try to consolidate or will give you the price action of your support and resistance. But in the opening market, you have no idea how you could have taken that trade. So step by step, we are learning to actually catch these big moves and the big risk rewards as well. And most of the time, why I say the opening trades are the best is because of the other reason, which is not written over here. That is the highest risk reward. For every penny that you're going to have risk on in the market, you're going to have the highest reward against that risk. You can actually use the risk rewards minimum up to 1:5. That means if you are risking $1, you should be making $5 against the same. So because these moves happen in the market, if you're a beginner or if you have already seen the market for some period of time, then you have seen how the market moves in the first opening hour. It has the highest volatility. And so we will go to the live examples as well. We are going to decode the charts of how we are going to use the setup. But while realizing or while expecting what can happen in the next day, it is very utter important that you need to respect the boundary of the previous day as well. You need to understand the price action. You need to observe it and make it very clear in your head where the price closed in the previous day. So that is why we have decoded, or we have decided that we can look the market in the three ways itself. Either it will be a last buy leg, it will be a last downside leg, or it will be a sideways in the market. Now comes the opening itself. So what we can do is to continue the trading in the opening market and to get the best result in the opening markets. Let's come to the next slide where we will understand the three possibilities in the opening hour of the market. market. So the tagline is very simple: the uncertain market, but there are very certain conditions that only these things will happen. And if that within those certain conditions, if we are able to realize or we can expect what will happen next, it will be very easy to realize some money out of it. So when the market opens, there can be only three possibilities. Either the price will gap up. That means if the price closed over here in the previous day, the price will start in the next day somewhere over here. I will show you the pictorial representations in the next slide as well. Or the price will gap down, or the price has started towards the sideways. So let's move on to the practical example. So this is how the price gives. As you can see that on the previous day, the market has closed around this level, while in the opening of the market of the next day, the price has gapped up and started from this level itself. This is how the price gaps up. This is one of the situations that can arise when the market actually starts with the first candle around 9 a.m. So you have seen over here, this is a very clear example. The price of the previous day closed at this level, while the next day started from this level. So this is all gap up, or basically known as the imbalance in the smart money concepts. Second is the example when the price actually gaps down. Over here, you can see on the previous day, the market closed at this level. On the next day itself, the price gapped down and started its first candle from this level itself. So we are using the chart of QQQ over here, and we are understanding and estimating how the price will react in the next momentum. So if I'm starting the day and this first candle has been made in front of me, then how can I expect near future price will be, and how can I make money out of it? For that, we have to understand that we have to first observe the previous day, and then whatever happens the first candle in the next day itself. So either the price can gap up or the price can gap down, and last but not the least, the price can open sideways as well. So this is the opening line, the shift of the day, and you can see what has happened. Price closed at this candle before the blue line, and when the next candle started, it actually started with the sideways only. Price could have started from this level, or price could have started from this level, but what we are seeing over here is very simple, that the price has opened sideways in the market. That is where the previous candle closed, next candle started within the range itself. So this is how we define whether the market gaps up, gaps down, or price moves towards the sideways. So now let's connect the dot of these two data points, and it will get easier for you. So this is how we can connect the dots. First, we have understood that there are three possibilities with the previous day itself, and there are only three possibilities of the next day itself when the opening market happens. So there can be 9 possibilities in front of you that can arise in any day. And if you understand in these 9 probabilities, if we try to decode the market and have the idea that if this happens, then this can happen, if this happens, then this can happen, then it will be a very objectified strategy. You don't need to rush up with your adrenaline in your brain and use your technical setups of here and there and different kinds of patterns and different kinds of things. You will just within a click, you will know that yes, this is the only possibility that can happen right now. And that is what we are trying to estimate over here. We are trying to connect the dots of the previous day and the new price day, and then we can expect very easily what will happen in the next hour. As soon as the first candle is made, we can expect what will happen in the near future price action around after 9 a.m. if the price will go up or if the price will go down, and I can make money easily on it. Okay, so what are the 9 possibilities? Combining the possibility of the previous day and the new day price are these. This is the previous day. Price has closed on the upside on the second half of the day. Against this, there are 3 possibilities that can happen. Let me draw over here. So this is the upside market in the previous day. Now against this, there are 3 conditions that can happen. Either the price will gap up. So price was closed over here, and again in the next day itself, the price actually gapped up and started from here. And what can happen in the next situation is that the price can gap down. So price on the previous day closed somewhere over here, while on the next day the price actually started from here. So this will be known as the gap down. And third, last but not the least, is the sideways. The price actually starts somewhere around over here only. Okay, so these are the 3 possibilities if the price closes towards the upside. Similarly, there are 3 possibilities if the price closes downside. The pictorial representation says, let's say if the price actually closes something like this on the previous day and the new day starts from here. So what can happen? Either the price will gap up, so next day the price first candle will be started creating from here itself, or what will happen, the price will actually start from this level. So this is known as the gap down. And with the downside, there is a last probability that if the price closes over here and then starts from here itself, then it will be a sideways opening in the market. Okay, so first we understood that there are 3 conditions that can happen with the upside. The market can gap up, gap down, sideways. Similarly, there are 3 conditions with the downside market: gap up, gap down, and sideways. And last but not the least, if the market closes sideways, as I told you in the previous days, if the price does something like this, and you will see that the price closed somewhere over here, that means at 12:30 the price was over here, and exactly at the closing time the price was over here only. So what can happen? Either the price will gap up, that means the next day the price will start from here, or the next day the price will start from here, or what will happen, the price will start sideways. Okay, so these are the 9 possibilities that will be there in the market and nothing else. See, we know that there are unlimited possible scenarios in the market. And if we try to trade in such an unlimited scenarios, then there is a high probability that we are going to lose money in the market rather than making out of it. So that is why when we try to trade in the market with the help of price action and with the help of limited possibilities that can happen in any time frame or in any time of the day, we try to decode of what we can do with those limited possibilities. If we are able to understand these are the maximum 9 possibilities, including the previous day as well as the new day price, then it becomes easier for us to understand what will happen in the next day itself. So what we are using over here is the closing of the previous day and the first opening candle of the new day, so that when we are trading in the next day, we are able to very well foretell in the market that what will happen next. So as you can see that you are trading at 9 a.m. or in the opening hour of the market, and you see that a big move is coming out, you will be able to know that yes, this move is expected, and you will be buying from this level and not from this breakout or this breakout where after the price shows you some kind of late reaction. You will be able to catch the trade at the very right momentum or at the very right opportunity, and that is how you can make money. Because let's say if you wait for the whole day and you see that there is breakout coming and then you take the trade or you place that trade over here, then you're a late buyer or late seller in the market, and you're not going to get big risk rewards. The big risk rewards are when you follow the footprints of the institutions and you make the same trades as they are doing as well. So that is how you will be able to connect the dots and you will be able to make some good money out of it. So I hope that you're able to understand that these are the only 9 possibilities that can happen. And now with the next slide, we are going to understand what are the possible scenarios. If we use this setup, if we use this observation, then what can happen next? So let's move on to the next slide. And before doing that, I will tell you that the next slide is in the next part of the video. We are going to reveal the whole setup tomorrow itself. Do not worry, just subscribe, like, and share, and go to our channel. The new video has been uploaded. I will also put the next video link in the description as well, so that you don't get confused or you don't get disconnected. Just look at the next video in the description and you will be all right. If you have any queries still over here, do not hesitate to talk to me, guys. If you're not finding your edge and you're still making stupid mistakes in the market and you are blaming yourself for your losses or blaming some situations in the losses and you're not making out of it, you're most welcome to talk to me anytime on one-to-one basis. You can mail me your queries, thenovalasset@gmail.com. And also I'm putting up a link where you can book a one-to-one live session with me and ask all your queries at once. Okay, guys, till then, take care. Hasta la vista. See you in the next video.